Hello and welcome to the Global View on this Monday. Well, US shorter dated Treasury yields rose on Friday after the Federal Reserve officials talked down the prospects of imminent interest rate cuts. New York Fed President John Williams saying that it's premature to speculate it, saying we aren't really talking about rate cuts right now. While Atlanta Fed President Raphael Bostic said he sees monetary policy easing sometime in the third quarter of next year, saying we've got to figure out definitionally what the neighbourhood looks like, where the inflation outlook is such that rate cuts are warranted. Over the next several weeks, I think we're going to start talking about that. Well, the US 10-year yield almost touched 4% in the wake of those remarks before slipping, and the 2-year at 4.45%. Data-wise, in the US, production at factories rose in November, lifted by a rebound in motor vehicle output following the end of strikes, but activity was weaker elsewhere. And a survey showed domestic business activity picked up in December amid rising orders and demand for workers. Well, the US dollar rebounded on Friday after those comments from Fed officials pushing back against market rate cut expectations, though the dollar did notch up its worst weekly performance in a month. The Aussie dollar, it's trading at 67 US cents. Well, for more on the macro and economic outlook for 2024 and how that's likely to influence investment decisions, Anthony Doyle joining us now from Firetrail. Anthony, very good to catch up with you again. Thanks for joining us. So, certainly, do you feel as though things are falling into place for investors, given that macro outlook, with inflation moving back in, well, towards that target range that central banks are after, of course, and now we're talking about those rate cuts?
Yeah, certainly. Over the course of the last 6 weeks, really since November, you've seen this narrative shift from recession to soft landing, and that's had obvious impacts for risk assets. And not only risk assets, but you've seen the forward curve in the bond market start to price in rate cuts, and that was subsequently confirmed last week by FOMC projections as well. Now, the median Fed forecaster is expecting 50 basis points of cuts by 2024. And the result is for global equity markets is that narrow leadership that we've seen with the Magnificent Seven this year. And we've seen that really broaden out to mid and small caps, particularly in the US. And that's a trend that we believe is likely to continue, not only from a valuation perspective, but we do think that the top in rates is particularly when it comes to the fixed income market, and that should provide a tailwind for risk assets like equities going into 2024.
Is there a risk, though, Anthony, that's been over-egged, that that's all been priced in and maybe then some, and perhaps that may lead to a bit of a pullback, certainly early next year?
Yeah, so when it comes to looking at market aggregates, certainly that can be the case. So when you are looking at these broad-based market cap weighted indices, they are dominated by few companies, and we know what they are, and they're household names. So we think that it is an environment where it is a more fruitful endeavor to actually be a stock picker and try and identify those companies that are likely to deliver over the medium term. So certainly in the short term, as is always the case, volatility is likely to persist, but it is an environment where you can't blanketly buy beta, you can't blanketly buy the index. With cash now having an interest rate associated with it, with the risk-free being materially higher than it was in the GFC years, it is an environment where we believe a concentrated high conviction approach is the most opportune to take at this point in the cycle.
So, position-wise, you mentioned the Magnificent Seven having outperformed this year, particularly relative to those mid and small caps. So, are you then readjusting exposure, particularly to the Magnificent Seven, as a result?
Yeah, so we own a couple of names there that everyone is very familiar with in Microsoft and Alphabet. But we are underweight the Magnificent Seven and have been really over the course of the last 18 months. Now, the Magnificent Seven, in terms of what's driven their returns this year. I think we all know very much about the secular drivers of artificial intelligence, and we've been getting exposure to that thematic by companies that we believe and that are trading on far more attractive valuations with similar levels of earnings growth. Companies like Micron Technology, companies like Taiwan Semiconductor. So we are actually overweight the AI thematic, but we're not overweight those expensively valued mega cap names. There's also another reason, a more technical nature for Mag 7 performing particularly well this year. Not only is it the passive funds that have flown in there, but a lot of active managers have sought safety in those names over the course of 2023, really on the uncertainty around the outlook, and given that they've been fearful to hunt further afield for alpha in the short term. And we think that that trend is likely to reverse to some extent.
So this leads to how you're doing this at the moment. Then Anthony is saying, well, it's very much bottom up for you. Stock selection individually. You're not looking at sectors as such.
Yeah, it always is, Andrew.
Yep.
So the stock overweights in our portfolio, or the sector overweights, country overweights, really are a function of that bottom-up stock selection process that Firetrail is so well known for. And when we look on a valuation basis, it is very heroic, the assumptions that our investors are making in buying a company like Nvidia or buying a company like Tesla today. And when you look further afield, as I mentioned earlier, companies such as AutoZone, similar earnings growth to the Magnificent Seven, but trading on half the valuation. And for us, share prices are the anchor. Earnings are the anchor that share prices will follow. And if earnings are rising, then share prices will follow accordingly.
All right. Well, I mean, I see that you've come up with a couple of stocks you're focused on at the moment. Let's take a look at those. The first one being Ryan Specialty. So this is insurance underwriting, and globally is where it's operating.
Yeah, that's right. Specializing in an area of the insurance market that's growing at double-digit rates. You're talking 20% per annum, and that's increasingly excess and surplus insurance. So we know that the world is growing more complex, and we know that it's becoming more difficult to get insurance under standard policies. You just need to talk to Aussies about, potentially their holiday homes or their dwellings being located on floodplains or in areas prone to climatic events such as coastal erosion or bushfires. Typically, they will go to the excess and surplus market to insure against those risks. Similarly, for increasing cyber insurance or cyber attacks, that needs to be covered under a separate policy in terms of cyber insurance. So Ryan Specialty Group, started by Pat Ryan, the former founder of Aon, trades on a PE of around 25 times, which is more expensive than the market, but is growing earnings at double-digit rates, and is consolidating the wholesale broker insurance network over in the United States. So that's an example of a company that not many Australians will be familiar with, but it is an opportunity to potentially generate alpha over the medium term by looking further afield.
Okay. And another one you're looking at is American Tower. So this is a REIT with a focus on communications infrastructure.
Yeah, a REIT dominant in the US in terms of providing the telecommunications infrastructure that we all know and love, particularly given mobile networks, and are expanding into emerging markets. And the reason I highlighted American Towers as one of our high conviction positions in the portfolio today, the Firetrail S3 Global Opportunities Fund, is I anticipate that bond proxy style companies like REITs, like infrastructure companies, are likely to come back into favor as we start to go into this interest rate reduction cycle. So over the course of the next 12 to 24 months, we will likely see interest rates fall. We've already seen a material move in bond markets, for example, as you mentioned earlier, the US 10-year flirting with that 4% level. And you can see the reaction in terms of the share price for American Tower as well. So we like American Tower for that bond proxy type nature, that exposure to falling interest rates. But of course, in terms of a growing addressable market in the emerging markets as well, for where they can start to build their towers.
Yeah, speaking of emerging markets, Anthony, more broadly, what opportunity are you seeing there at the moment? I guess particularly relative to that opportunity you're taking of those US listed stocks at the moment.
Yeah, so EM as part of the portfolio is around 7% of the portfolio. So I mentioned Taiwan Semiconductor earlier. We also have exposure via HDFC, which is a blue chip Indian bank, the largest privately owned bank in India. We also own a couple of infrastructure plays in terms of a couple of Mexican airport exposures as well. And that's, as I mentioned, a relatively small part of the portfolio. But certainly when you look at emerging markets, there are fantastic businesses there that trade at extremely attractive valuations, but you are taking a little bit more risk to move to position into those markets relative to developed markets.
Anthony, great to get a view of your investment strategy there at Firetrail with a look ahead to 2024. Thanks so much for joining us.
Cheers, Andrew. Thanks for having me.
All right, let's take a look at where we're likely to get going. As you can see, looking for a leg down to begin the trading week there with SPY futures off 1%. All right, the open is just around the corner, so stay with us.